Hey, all right, everybody. It is Tuesday, August 27th. You may recall last week I spoke about a slowdown in the rate of government spending growth. Now, for those of you who have been following me, this is the core of what I do in terms of my analysis. I look at fiscal flows. Government spending, and I guess you call it the second derivative of that, is the rate of spending growth. And all along, my bullishness has been really based on this, primarily the fact that we are seeing we're still seeing record spending this year, up $261 billion over last year, and on track to hit a new all-time spending record, surpassing last year, which was also an all-time spending record, but we're up significantly this year. However, in the last couple of weeks, and it has really become apparent, I guess, in the last 2 weeks, there has been a very noticeable slowdown in the rate of spending growth. And the year-over-year increase in spending, while it is still very large, it has narrowed somewhat. Maybe you heard me talk about this last week. And so my outlook on the stock market and on the economy, for that matter, has become more cautious. Now, you may recall I was looking for a big rally around August 8th, starting on August 8th. By the way, that still is the bottom of the recent correction when we hit 2775 on the very early morning hours of August 8th in the S&P. And we went up over to 2930, and now we're down around 2860, I think, 2866. The slowdown in the spending growth rate, that's no good. That is no good. Now, I do think this is temporary. There are some elements in this, as far as my analysis is concerned, that makes me feel that way. Of course, you want to know more about this. If you want to get a better in-depth perspective, you got to go to my website, pitbulleconomics.com, and sign up for a 30-day free trial of MMT Trader. But I just wanted to bring this to your attention. So the slowdown in the spending growth rate is very obvious now. It is not extreme by any means, but it is noticeable. And therefore, I have become cautious on the outlook. What does that mean? Well, you're going to have to sign up at least for a free trial to understand what that means. On another note, we saw an 11 million barrel drawdown in crude oil inventories in the APIs that just came out about an hour and a half ago. That was the largest draw in 2 months. The level of crude inventories right now is at the lowest level in 10 months. We also saw a marginal draw in gasoline. We saw a pretty good draw in distillate, the largest draw in 2 months in distillate. Tomorrow, the EIA Weekly Petroleum Status Report comes out, and as I always do every Wednesday, I put out a very in-depth analysis of that. We have crude oil at this hour nicely above $55 a barrel on WTI. It had a good pop after the API number came out. I have been bullish on oil. We have been buying the dips down in the 53 handle, in the low 54 handle. We're up in the mid to high 55 handle right now after that API report. There was some, if you are a zombie trading subscriber, I sent out some recommendations based on every week off of the APIs and the EIA petroleum report. We have Forex trades that are made, which are very, very profitable. And I sent that out. If you want my recommendation, if you want what I sent out, go to my website, pitbulleconomics.com, and sign up for a 30-day free trial of zombie trading. And you will get that recommendation. There is still time. We jump into these moves And very often, particularly with these oil inventory reports, which affect Canadian dollar, Canadian cross rate against US dollar, against Japanese yen, and other forex. Forex is great, by the way. You may want to sign up if you didn't get it, or you may want to purchase my 25-hour Forex video course, which is also on my site. But Forex is excellent because you can basically construct any sort of a market proxy using, or any sort of a market outlook or scenario using Forex as a proxy. And we could trade oil based on currency. So I sent that out, and if you want that, again, go to my website, pitbulleconomics.com, sign up for a 30-day free trial. So yeah, that's it. And one final note, this is an ongoing, analysis by me. It is an ongoing, position. The fall in bond yields, the rise in bond prices. I have said recently, and I have been saying, that this is tied to the debt ceiling when that was in effect from March until the end of June. That was a 4-month period that saw basically the entire world starved of U.S. Treasuries because there was no new issuance. If issuance had been ongoing in that period, we would have had well over $1 trillion of new issuance. That did not happen. So basically, the entire global financial system was starved of the most important financial collateral, which is U.S. Treasuries. And what you are seeing now, and by the way, since the suspension of the debt ceiling on July 26, when Trump signed that, it has been a slow trickle of new issuance. It's going to take a while now to replace those treasuries that had not been sold over that 4-month period. Now, I know everybody is saying that the yield curve and the drop in yields and the inversion in the yield curve and this and that is a forecast of recession. And by the way, I might have to flip around on my outlook, because if this spending slowdown continues, that does raise the risk of a recession. But right now, I think we're going to be fine. But anyway, the bond yield drop, in my opinion, has to do with the fact that we've had a 4-month period that was devoid of any new treasury sales, squeezing the entire global financial system of its needed collateral at a time when, over that time, the Fed was reducing system reserves in the banking system. So banks had to acquire treasury. You could see it very clearly. I put this out every week in my report, how banks were going nuts, falling over themselves in an historic fashion, buying treasuries to replace lost reserves, which are tier 1 assets. They had to replace it with other tier 1 assets, being treasuries. Had nothing to do with any recession. Look at today. We had booming consumer confidence, retail sales still very strong. If you look at gasoline demand, very strong. If you look at U.S. Crude oil and petroleum product exports, very strong. If you use those as barometers, among other things, of global demand. Look, bank credit, I've been talking about all this. All this stuff should be collapsing if there was a recession. None of that is happening. Anyway, all this stuff is at my website, pitbulleconomics.com. You want to be informed? You want to have knowledge? You want to have mental game? You want to have the correct understanding? Go there, pitbulleconomics.com. Sign up for a 30-day free trial. Bye.